What's up, YouTube? In this video, we are back with some Enphase Energy, ticker symbol ENPH. Enphase reported their Q3 23 earnings, October 26th actually. They missed on revenue, just barely, but beat on their EPS. The reason why the stock fell so hard is because of their Q4 guidance that they gave out. But Enphase did come out with a new little press release here to give us a little bit of an update as to where the business is headed and how things are shaping up over there in Enphase. And what they've done is they've laid off 350 people and they've ceased manufacturing operations in 2 locations here. So there's a few key points within this small little article here. Actually, really the whole article is very insightful. I think it was very, it gave us quite a bit of guidance as to what to expect in the future, at least in the next like 12 months roughly for Enphase. But it said, as it says in the title, it cut its workforce by about 10%. So that should be pretty decent on their operating expenditures going forward. That the fact that they cut off 10% of its workforce, and then also it stopped contract and manufacturing operations at 2 of its locations. Down here though, however, it's not a bad thing because if they're not putting out a lot of inverters, they did go from 10 million units per quarter down to 725 million microinverter units per quarter. So we're seeing a reduction in overall output. But I mean, if the output demand is not 10 million units, then why make 10 million units? You're just going to see a huge increase in your inventories, and investors do not like seeing that whatsoever. So that is another positive to see. Okay, we're going to cut back on our outputs. We need to go through our current inventories before we start continuing to ramp up production again. And then also down here, the company estimates that it will incur approximately $16 to $18 million in restructuring and asset impairment charges, and approximately $7 million of that will be used in cash expenditures, and we'll see $15 million of that coming out in the next quarter. So I think next quarter is going to be probably the worst read we'll have, and then hopefully starting Q1 of 24 for this company. I think is when things will start turning around. So I think next quarter, Q4, is not going to be very good, but I think investors will look through that. I think that's potentially already priced in. However, I think they're going to be really focused on is the guidance that they're going to give out to know, okay, how are things shaping up? When are things going to start getting better over here at Enphase? And they gave us a little bit of guidance into that here is, they're focused on the first half of 24. They will be clearing the excess inventory in the channel worldwide. So obviously that's why they reduced their microinverter output. So that way they can start cycling through their inventories that they have now. But however, they see that there is greater confidence in the U.S. Federal Reserve cutting the interest rate next year. So obviously because of that, the high interest rate is causing people not to take out loans and to pay for their solar that, on their houses or commercial or whatever it is, because obviously interest rates are kind of really ridiculous at the moment. You don't want to. You're used to like 3-5% interest rates, and now you're looking at double that on whatever you're trying to buy. And especially for solar, you're going to be paying like probably 9-10% for to have solar installed on your house, where it used to be like 5% or something like that. So that is definitely a very important contributor to Enphase, is to have lower interest rates, which the Fed is already forecasting in their dot plot at least 3 potential interest rate cuts next year, and the market is pricing in, I think, 6. So that'll definitely help out Enphase overall in fiscal year 24. But over to their most recent 10Q that they released to us, we are on their assets, their balance sheet here, and we've got $290 million just in cash and $1.5 billion in marketable securities. So I like that. I like that move. I like that they've got majority of their cash sitting in marketable securities, so that way they can earn interest. So instead of just having the cash just sitting there, if they got no other use for it, especially right now, they probably want to be very protective of their cash because they know this is a slow time. They know they've got to just hunker down and make do with what they've got. And then once things start turning around, then they can start working the business and start investing into the business again. So I really like this. Personally, I like what they're doing overall financially within the business. So we can see they're doing that. They're putting all their money that they can into marketable securities so they can earn added income in interest every quarter, which is very good. I like that a lot. We come down here to current liabilities and overall long-term liabilities. We can cross off deferred revs, which I've done over here. We got 114 million and 366 million in long-term deferred revenues. And with that, we got $774 million in short-term debt, minus 114 deferred revenues. And that gives them with $660 million in short-term debt. And we are sitting on $1.8 billion in cash. So in short term, companies got plenty of cash to weather the storm, and they're still making free cash flow at the moment as well. So there's no concerns there whatsoever. And overall total debt sitting at $2.5 billion, minus $480 million of deferred revs, leaves them with $2 billion in total debt and $1.8 billion in cash. Still a very solid balance sheet because they are still making positive free cash flow as well. Very good balance sheet. Down here to our income statement. So what we can see here is 2023, this is in 3 months. We went from $634 million down to $551 million. Then we come here to cost of revenues. And we can see cost of revenues obviously also went down. But look at this, gross profit, 262 compared to 267. So basically year over year, slightly down, but basically flat, even though we made about $80 million less in revenue. But this is where that Inflation Reduction Act comes into play. Is what they're doing is obviously they're going to probably reduce their cost of revenues, or this is coming into their overall gross profit somewhere, that Inflation Reduction Act that they get a little kickback on for all the solar that gets sold in the United States anyway. So you can see that year over year on gross profit still hanging in there. So that's good to see, especially so that Inflation Reduction Act is kicking in just in the nick of time for this business to keep its financials looking pretty decent. So we come down here to total operating expenses. We can see they are up year over year about $12 million, but we know they just reduced their operating expenses, at least in the, maybe everywhere, depending on how they cut jobs. But we could probably see about 10% knocked off of that. So we're probably sitting back down into the low 130s, maybe high 120s for overall operating expenses. So with that, we can see here now interest income from all their $1.4 billion in securities. We're earning interest income every quarter of about $20 million. So that's very good. That offsets their interest expense and then some. So we get to add quite a bit of money down to our bottom line here. And that gives them $114 million of net income. And again, year over year, pretty good. We're only down $1 million. Pretty good. And then also down here, they do have a share buyback program, but I would not be expecting any shares to be bought right now just because of the uncertainty of the future. So I would not expect to see shares being reduced. Maybe slightly diluted because they do hand out stock-based compensation. And down here to our cash flows, we got net income in the last 9 months of the year 2023 here of $418 million. We get to add in a little bit of depreciation as well. And some other things, we got stock-based compensation here at $157 million. So this is where some of that dilution could come back into play. So we might see an uptick in share count in the next quarter or two, and maybe they'll start feeling comfortable and start buying back shares again in the near future. But with that, we can see the company produced $661 million cash from operations. We do have $90 million in capital expenditures. Not real sure why there's a $60 million uptick in capital expenditures. Potentially something worth looking a little bit deeper into as to why and what's causing the significant increase there. But even with that big increase, we're still positive free cash flow in the last 9 months of $571 million. And then we come down here to our cash flows from financing activities. And we can see company bought back $310 million of stock, and that offsets our stock-based compensation by quite a bit. So then we're buying back more shares than they are issuing, so that is good. And then down here we can see overall we saw a net decrease in cash position. So if you wanted to, you could say, okay, this is where I would expect them to say, okay, we're not going to buy back shares right now. We were negative in the last 9 months, $183 million. So that cut into their overall cash position a little bit. So I would probably expect them to not do this, buy back any more shares, just to maintain their cash position the best that they can. I think right now is not a great time to be buying back shares. Like, obviously the stock is cheap, but at the same time, it's like, yeah, but at the same time, you need the cash, right? I would rather them hang on to cash, maintain a strong balance sheet than buying back shares right now with an uncertain future as to when interest rates are going to start cooling off and the company can start ramping back up production again. But over to our financial spreadsheet here, and there is a link in the description down below to the Patreon if you want access to this spreadsheet where we got financials, we got some comps, calculator, DCF valuation, and then a final valuation, which you'll see here shortly as to what this company is currently worth. We'll come over here to the charts on all the financials. We got a revenue, gross profit, and net income, and it's just a very nice chart. They're all just exploding higher, all in sync with one another. We can see revenue, gross profit, and net income all trending in the right direction. We can come over here, see our net income is just exploding in the right direction. Very good. And our margins, though, this is where things just, on this company, I just really like. They got such good margins. Sitting at 47.5%, and it just continues to get better and better. This is in the last quarter even. So in the last quarter, this also slightly includes the Inflation Reduction Act as well, so it's making it look a little better than what it would be without that, obviously. We'd probably be more down here in the 40s, lower 40s, but with that being included for the next few years anyway, we're seeing some pretty nice margins back into the business. And over here to net margins, same thing, last quarter, 20.7%. We're hanging out right around that 20% range in margins for net margins, so very good over there. Return on invested capital sitting at 22.6%. That's fantastic. PE ratio today, 32. Historically, obviously, significantly higher, but you could argue that today, potentially a little overvalued. Cash to short-term debt, we've already gone over that, and we can see cash to total debt. We do have, obviously, this doesn't strip out those deferred revenues, but we can overall see, even without those, with those being added in, we're still pretty close to having the same amount of cash as to debt. Down here to net income to free cash flow, company produces more free cash flow than net income and just continues to grow and grow and grow. Even when things are kind of not that great, it is still heading in the right direction. Probably not going to be look that good next year, maybe, we'll see, but obviously that is to be slightly expected, and if they can continue this trend, that would be even better. That'd be fantastic. And we got free cash flow. I mean, this is just starting to explode. Capital expenditures, pretty nominal at $107 million for CapEx overall for the year. Obviously, we saw a $60 million increase in the last 9 months on our capital expenditures. So again, something to keep an eye on and maybe figure out exactly what that could be associated with. It could be just a one-time thing as well. And over here, share count dilution, we have been diluted significantly, but has leveled off. It's just sitting at 142, 144 million shares since 2020. So have not been significantly diluted anymore, which they don't need to. They're for positive free cash flow, and they have a very solid balance sheet, so they should not need to dilute shareholders whatsoever going forward. Over to the comps, I have 3 other companies that I put in here. I got SolarEdge, First Solar, and Tesla. Tesla does do inverters, but obviously Tesla is a little bit of a different animal when it comes to comparables here, so we will pull Tesla off of the list. And we'll compare it to SolarEdge and First Solar. SolarEdge also does inverters. First Solar, I do not think does any sort of inverters, but it is part of a solar industry, so we'll just include them on there and compare margins a little bit. So we come down here and check out our margins. For some reason, First Solar's margins are not popping in here, but we can still see them up here. But we can compare margins. We got gross margin 45%, 29% on SolarEdge, 27%. And then we got operating margin right below that. So First Solar has some pretty decent operating margin. And then we have profit margin 15%, 6%, and 21%. So First Solar has got some pretty good margins on it as well. And I believe they just do solar panels. And so First Solar is actually one of my favorite stocks as well. I do not own it yet, but it is one that is on my list to buy in the future. And Enphase, full disclosure, I do own a lot of Enphase. It is actually my biggest holding that I have. But we come down here, we can compare free cash flow. First Solar is negative, but Enphase positive free cash flow. Return on invested capital. I mean, so Enphase just has such good numbers within it. It just seems to be very well ran. It has very good margins. And First Solar, though, I still really like First Solar as well, and I'm not going to hate on that. SolarEdge, I'm not a real big fan of. They're overall okay, but I prefer Enphase, and First Solar. And over here to our valuation spreadsheet, figure out what this thing is worth. So what we're going to do is we're going to type in, we've currently got our today's earnings per share and PE ratio. And then once we get the valuation of today's numbers, we'll circle back, put in forward-looking numbers that we'll pull in from Seeking Alpha here. We'll pull in 4.42 and 30.6 for our forward-looking numbers and figure out what this thing is worth in the future as well. So today, Peter valuation gives them $83.58. Multiples comparison, $124.54. And today, it would take Enphase about 20 years to earn its current market cap, so not too bad. Price to book, 5-year average is 35. Today, sitting at half of that at 17. PEG ratio, they're not forecasting any real good revenue growth on Enphase here. So that gives them a pretty low PEG ratio because of the low growth rate. And then Graham's valuation gives them intrinsic value of $167.21. Over to our discounted cash flow valuation. So we got 24% growth rate from analysts for free cash flow. Historically, 176%. So we can see that their free cash flow just continues to get better and better and better year over year. So I gave them 21%, kind of met them in the, just went on the little bit of the lower end of where analysts were. That still gives them a DCF price per share of $159.46. Rule 72, we have 3 sources of an EPS growth rate for an average of 22. And then what we do with that is that goes into 72 3 times. That goes into 10 years 3 times, basically. And so then we get double our current EPS 3 times. So then that would be a future EPS of about 31. Gives us a fair value of $342.10. So over to our summary here. We've got Enphase sitting at $128 even. Fair market value, $175.38 with a 30% margin of safety is $122.77. Analyst price target, $166.63. So we're not too far from where analysts are either. But let's circle back and plug in our forward-looking numbers here. So we got a forward EPS of 4.42 and 30.6. So we plug in those 2 numbers, and now we got a pure fair value of $93.76. Multiples comparison, $139.72. Intrinsic value on grams, $187.58. DCF won't change. Rule 72, we can slightly adjust higher. We'll do about 35 on that. So with that, we're looking at $386.24. And then our final valuation, forward-looking, sitting at $193.35, 30% margin safety, $135.35. Now over to the stock chart. This is where it gets a little more exciting because we have broken trend. So what we would like to see happen on this chart, so we can see we're in this downward trend, and every time we hit this blue line, fails, blue line, fails, blue line, didn't fail, broke through some support like it wasn't even there, actually resistance at that point, broke through that orange line and the blue line and is making its way back up potentially to this red line. But what we would likely see here, actually there's another blue trend line here too that we can darken up here. It's looking like it might be getting rejected there, and it is getting rejected. We got a tail, we broke through, but looking like we might pull back. What I would expect on this one is a retest of this blue line. We might come back down to like $100, $97 roughly. Retest this blue line, maybe even just retest the orange line. And then maybe we start finding our way back up higher here, especially if once we get next quarter results and some potential guidance within the business. So after the news report that they put out about cutting jobs and shutting down 2 factories, reducing their output of product, this stock jumped from $90 or like $94, $95 all the way up to like $128 in like one day, or a couple of days at least. And this is a 1 week. This happened last week, so it made a significant move in the upward direction because all it needed to do was just a little bit of like positive, like things that investors want to see, and that's what they did. And that's what it did to the stock. It pushed it up like 10%, 15% in 1 week because of that. So I think there's a lot of people just waiting on the sidelines for this one, wanting to buy it, but they're just not ready yet because they don't know what's going to happen and they don't want to jump in too soon. And as soon as we start seeing some good news pump into this stock, this thing I think is headed back up into the 220s, 250s. Because the reason our valuation is sitting at about $200 per share is because of the low expectations of growth. Once we can start seeing some more growth come into this company, this business, we're going to see this thing have a fair market value again of like $300 per share. We did earlier this year, but now obviously growth has slowed down significantly, so it's not valued as high as it used to be. So that's what we're kind of waiting for and seeing on this one. We're expecting this to get rejected here, pull back. Not sure if it's going to hit the blue line, maybe this orange line, consolidate, and then potentially again with earnings and some good guidance and some good forecast, we could potentially see this thing roar higher, which will be fantastic to see. So, but that is it for Enphase. If you found value in this video, drop a like, subscribe, and comment back later with another stock analysis video.